All right, let's dive right into this explainer. Today, we're decoding some truly massive and honestly pretty paradoxical shifts happening in the post-blockade economy. We're looking at a landscape right now where the headlines are telling us one thing, but if you look under the hood, the actual data is screaming at something entirely different. So let's break down what we call the echo shock paradigm and figure out exactly how we need to navigate the third quarter of 2026.
Right off the bat, we've got to ask ourselves the big question. The blockade? It's over. Markets? They're hitting absolute record highs. But is the crisis really behind us? To understand what's actually happening out there, we have to look right past this illusion of a perfect, frictionless peace. We need to dig up the deep structural vulnerabilities that are hiding just beneath the surface of all these soaring stock charts. So let's start with the catalyst. Just look at the sheer velocity of this timeline. Early Sunday, Israel strikes targets in Beirut. We're talking high crisis mode. But then, bam, a massive pivot late Sunday. The U.S. abruptly ends the naval blockade at the Strait of Hormuz. And by Monday, mediators are already prepping for technical talks in Switzerland. It's wild. This incredibly rapid sequence essentially injected a sudden, massive peace dividend straight into the market. And you can see exactly how the market reacted to that news. On one hand, risk assets absolutely skyrocketed. We saw the S&P 500 futures jump, the Nasdaq leap, and Bitcoin completely smash past 65,000 for the first time since early June. I mean, it was a textbook relief rally. But then, flip the coin. Safe havens and crude oil? They completely plunged. Capital just drained out of defensive sectors. It looked like the perfect relief rally. But here's the catch. The underlying fundamentals of those physical assets being sold off, they're telling a way more complicated story.
Which brings us to Section 1, the energy paradox. Falling prices versus empty tanks. Now, here is where that perfect relief rally narrative completely falls apart. We're seeing a really dangerous disconnect right now between the financial screens that everyone is busy charing at and the actual physical world we live in. It's kind of like an iceberg. Above the water, the visible financial reality is plummeting crude prices. We're talking approaching $80 a barrel. Financial markets are literally just shrugging off supply warnings. But below the waterline, the hidden, physical reality is actually pretty severe. The world is guzzling oil way faster than it can be replaced, and U.S. storage hubs are dipping dangerously close to their absolute minimum operating levels. We are in the red zone here. If those minimum levels get breached, prices are going to have to violently snap back to stop a run on supplies, and that's regardless of whatever peace deal got signed over the weekend.
And hey, you don't have to take my word for it. Just listen to the alarm bells ringing straight from the industry heavyweights. Mike Wirth, the CEO of Chevron, is outright warning of an impending supply crunch. And over at ExxonMobil, Neil Chapman is pointing out that we're approaching unheard-of inventory levels. These guys are telling us, point blank, that physical constraints are eventually going to completely override all this financial euphoria. At the end of the day, a physical barrel of oil always beats out a paper contract.
Moving on to Section 2, the echo shock trap. False signals in the macro tension. All right, this brings us to the absolute core of what we're looking at today. Check out how these two curves intersect here on the Citrini research model. When Hormuz reopened, it dropped energy and input costs immediately. That's wave one, actual pricing pressure dropping incredibly fast in mid-June. But, and this is a massive but, the official inflation data for June and July is going to lag behind. It's going to spike to what we call an echo peak, because it's reporting the ripple effects from way before the blockade even ended. So the measured inflation is peaking at the exact same time the actual pricing pressure at the source is reversing. So what's the big takeaway here? Don't trade the echo. Seriously, make this your mantra for Q3. All that algorithmic capital and those reactive traders, they're going to completely misinterpret these artificially hot inflation prints. They're going to see that lagging data, and they're going to panic. We've got to be smarter than the algorithms here. Do not let a robot panic you out of your position based on outdated data. We absolutely have to differentiate between the real structural realities, like that source drop, and these false lagging data signals. That leads us right into Section 3, euphoria and hidden strains. The sector rotation divide. Let's pivot over to the real economy and see how this whole paradox is actually playing out. We're seeing this massive divide across sectors where extreme euphoria is totally masking some really deep operational frictions. At the very top of the market, it's pure, unadulterated euphoria. And nothing captures this better than the monumental SpaceX IPO, which slapped a mind-blowing $2.1 trillion valuation on the company. Because it's so massive, its entry into the Nasdaq 100 mechanically forces tracking funds to buy an estimated $7 to $10 billion of its stock. And that's regardless of the fundamentals. It's just a huge influx of capital driven purely by momentum and, the shiny promise of low-cost, space-based AI data centers. But man, this kind of retail frenzy definitely brings up the infamous shoeshine boy index. It's a classic historical sentiment diagnostic. Back in '87, it was construction workers debating stock charts on site. In '99, it was your dentist bragging about .coms while checking your teeth. In 2008, it was your mechanic giving you mortgage tips. All of those turned out to be massive crash indicators. Fast forward to today, when conservative municipal bond clients are suddenly demanding SpaceX and your house cleaner starts pitching you on AI chip stocks, you really have to honestly ask yourself, is this just the new permanent democratization of the market? Or are we looking at a really dangerous euphoric top? To answer that, let's compare those high-flying AI valuations to the massive red warning signs flashing in the real economy. On one side, sure, you've got this euphoric AI momentum, but Goldman Sachs is actually warning that the massive capital expenditure in AI is generating this rising tide of depreciation expenses. It's essentially causing a severe structural drag on return on equity, literally eating into the actual profits of mega-cap tech. And if we look entirely away from tech, traditional supply chains are sounding the alarm. The U.S. cattle herd is sitting at a 7-decade low thanks to drought and feed costs, absolutely crushing meatpacker margins. Even worse, consumer credit delinquencies are creeping right back up to 2008 financial crisis levels. So while space and AI are hogging all the headlines, the foundational, everyday economy is flashing some severe recessionary warnings. And that brings us to Section 4, the Post-Blockade Playbook, Strategic Imperatives for Q3. So let's pull all this together. How do we actually position ourselves in an environment where the macro data is straight up lying to us, tech is living in a euphoric bubble, and the real economy is visibly straining? First off, you've got to understand that the era of a unanimous, predictable Federal Reserve, it's over. Under Chairman Kevin Warsh, you should expect a highly divided committee with conflicting rate projections and some very vocal pushback. You've got one path where Warsh holds rates steady, embraces this AI deflation narrative, and pushes the market even higher. But then you have the alternative scenario where the Fed fixates on that sticky core services inflation we just talked about, leading to a surprise rate hike that completely throws the hawks under the bus. So let's distill this into an action plan. 3 absolute imperatives for you. Number 1, don't trade the echo. You're going to see distorted, hot inflation signals this summer. Expect them. Do not let the algorithms panic you out of your positions. Number 2, monitor the physical, not just the financial. $80 oil is a reality on your screen, but depleted storage is a real physical constraint. And eventually, the physical world is going to dictate the price. And number 3, prepare for a fractious Fed. Allocate your capital assuming a high level of policy unpredictability and some very public disagreements within the Fed. So as you take a look at your portfolio tomorrow morning, I want you to ask yourself one defining question. Are you just trading a financial echo, or are you actually prepared for the physical reality? Look, financial illusions eventually shatter. It's just a matter of time. You need to make sure your capital is standing on solid ground when they finally do. To really thrive in this post-blockade economy, you've got to look beneath the surface, tune out the noise, and stay fiercely focused on those physical constraints. Thanks for joining me, and I'll catch you on the next explainer.